Hi, this is Stephen here from Share Navigator, and today we're going to share with you the bear call spread strategy. So it's a credit spread. Here's the overview of what we're going to cover. You can pause this and go through it yourself, but we'll do a real life example, show you how to set up the trade, and we'll also prepare and show you the P&L for doing a trade with this on SPY. So the bear call spread, it's a mildly bearish credit spread. So you're getting paid in advance to place the trade. The reason we say it's mildly bearish, if you were out and out bearish on a stock, you would buy a put option or just short the stock. That might be a better way of playing it. So this is a mildly bearish play. So how do you go about constructing the trade? Well, there's two parts to it. First part is the seller call option at a strike price. We would recommend out of the money, and we'll explain why later on. And the second part of the trade is to buy a call option at a strike price above the short call for the exact same expiry. Now this is placed in your broker as a combination trade, as one trade. So let's go to the demo account and do this for real. Here we are, we're in the order management window. This is a spread trade, so we click on spread, and it's a vertical strategy. So we're going to type in Microsoft. We'll do an example with Microsoft, and watch what happens when we type in Microsoft. Two order windows automatically open up down here. So the first action is to sell the Microsoft. The expiry is always populated to the nearest term expiry, so we're going to go out a couple of weeks. We go out to June. And Microsoft is trading at about $47, $48. So we're going to use the $50 calls. So we're selling, the first part of the trade is to sell the $50 calls. Now the second part of the trade, as we said, we need to buy a call option at a strike price above. So we're going to pick 50, 51. And we're going to get a bid-ask spread here for the total trade of 15 and 8. So you can see where we get that from. So if you think about it, the first part of the trade is to sell the $50 call and you're collecting in 57 cents. But then you're paying out 49 to buy the $51 call above it. So that will give you a net bid of 8 cents. And if you do the same on the other side, you'll get a net ask of 15 cents. Now, in real life, if you were placing this trade, we would suggest that you haggle with the market. Don't take the lowest bid, haggle somewhere in the middle, and you will have a good chance of getting filled. But because we're just demonstrating, we want to show you how this trade is placed. We're just going to accept the first offer, which is 8 cents. We're going to click on preview order. Are you sure you want to place this trade? Yes, we are. So we click on submit order, and that's gone through to the market there now. So we're going to go back to our positions. You're going to see this is going to be updated in a moment, and you're going to see a short call for Microsoft, and you're going to see a long call for Microsoft. So here they are, the short $50 call, and we're long on the $51 call. So that's how you place a bear call spread in the Interactive Brokers web trader platform. We're going to go back now and do a real life example with SPY to the presentation. So SPY is trading at $211.17 at the moment. We're actually looking to place the 216, 215, June 19th expiry bear call spread. So what's the first part of the trade? Well, we're selling the 215 call and we're going to receive in 66 cents per share after costs. And the second part of the trade, we're going to buy the 216 call and pay 42 cents per share after costs. So our net credit to us is the difference between the two, which is 24 cents or $24 per contract. What's the risk in this trade? The great news is it's totally limited, and it's limited to the difference between the strike prices minus the credit you've received. So for our SPY trade, the difference between the strike prices is $1. We've received 24 cents in credit, so our total risk is 76 cents per share or $76 per contract. So the great news is that's all you can lose. Your risk is defined before you even place the trade. So what about the profit? Well, the max profit is basically the net credit you've received. So in this case with SPY, it was $24 per contract. Now, we achieve the max profit once SPY finishes below the short strike price, which in this case was $215. In terms of break even, the break even is equal to the short strike price plus the credit received. So for the SPY trade, our short strike was 215, our premium received was 24 cents, so our break even is $215.24. So as long as the shares of SPY finish below $215.24, we're going to be making some sort of a profit. So what type of leeway do we have in this trade? Well, remember, the shares were trading at 211, 11 cents. Our break even is 215.24. So the shares could actually rise 413 and we would still make a profit. So in percentage terms, the share price of SPY must move by about 2% in a month before we start to lose. What is the probabilities of success? Well, most good options trading platforms have probability calculators for your option trades. And that takes all the calculation out of it for you. But in this particular trade, we have an 80% chance of winning. So it's a high probability trade. But please remember risk and reward. Even though we have an 80% chance of winning, that means we have a 20% chance of losing. So while our probabilities are very high, the trade can still go against us. So remember to trade small and trade often. That's the key to success in option trading. And in the bear call spread, the effective volatility really depends on whether the calls are in the money and also at their time to expiration. The effective time decay really depends again on where the stock is trading. So if SPY is trading closer to the higher strike, losses usually increase at a faster rate as time passes. If SPY is trading closer to the lower strike, which in our case is 215, profits will increase at a faster rate as time passes. So how do you go about picking the strikes for a bear call spread? Well, it really boils down to how bearish you are. And if you are very bearish, you would pick strike prices which are in the money. Now, we said at the beginning of the presentation, pick out of the money. And the reason is, if you go in the money with your strikes, your probabilities of success actually drop. You're getting paid an awful lot more to place the trade, but your chances of winning drop. Whereas if you go out of the money, your probabilities of success increase. The downside is you're not getting paid as much to place the particular trade. Somewhere in the middle is moderately bearish. So this is where you're picking a strike price which is in the money and out of the money. So the share price is stuck in between the two. We would recommend that you go on the least bearish route and use out of the money calls. For our SPY trade, we were least bearish. Now, another thing to note as well, the wider the strikes you place, the more risk you take. So we placed $1 wide strike on SPY, but if we could have picked a $3 or a $4 strike. Now, if the share price moves against us and we've picked a wider strike, obviously our losses are going to be greater. So the wider the strikes you pick, obviously the more risk you're taking as well. How do you go about managing the trade? Well, the trade can be closed at any stage. Simply buy back the short call and sell the long call. It's usually left until expiry Friday before you do anything. If the share price is below the short strike, you don't have to do anything. Both calls are going to expire worthless. However, if the share price is above the short strike at the expiry, then you need to close the short call position and then sell the long call position if there's any premium left in it. Okay, this is Stephen from Share Navigator. Our training is free. Please share this video with your friends via social media. Go to our website and get some of our trades live at www.sharenavigator.com. Thanks and bye for now.